conversation a lot. A lot of times it comes down to a lot of personal choices on that. But we're kind of finding things to the baby boomers because the whole IRAs and 401ks came out during the 1986 tax reform. So that was the big tax thing with all the retirement accounts. So everyone was thinking pre-tax, we'll save money on taxes now, we'll be in a low bracket in those retirement years. Now those baby boomers are now retiring and they're hitting the required minimum distribution age. All of a sudden that R&D is causing a very large jump in taxes. And so it's not, they end up getting double taxation almost.
For those of you that don't know, my name is Jaimin Garabedian. I'm the founder of Assurance Wealth Management. I am a financial advisor, but as things go today, I am not your financial advisor on this webinar. This is not intended to give you any advice. This is just for educational purposes. Luckily, I've got Rachel Knapp here with me, who is a CPA and managing partner at Ramdas Accounting. Again, for all of you compliance and attorneys out there, she is not giving anybody any advice on this webinar today. This is all for educational purposes. If you need anything or have any questions about your own personal situations, feel free to reach out to either one of us. We'd be happy to help. But Rachel, thank you for coming on again. I know that we did this a few months back with you and had a couple different topics, but I think we had such a strong showing and big response from you coming on here. I think a lot of people have a lot more questions about taxes. So thank you for coming on.
It's great. No, thank you for having me. And it was fun last time. I know we covered quite a bit last time, and we're going to cover a lot more this time. So It's going to go quick.
We're going to try to go through this as quickly as possible. And I know there's a lot. So if we touch on a subject that you want to know more about, again, please reach out to one of us. If you see there on the offers tab in the webinar, you can schedule an appointment, just a phone conversation with me right there. Get on our calendar. And then if it has something to do more along the lines with what Rachel's talking, we will bring her into that conversation as well. But we're here to help you. We're here to educate. That is the intent of these webinars, is to teach as much as we can. So let's dig in. We're 5 minutes in, but we've got a lot to cover. So
all right.
As far as housekeeping, we're going to do this one a little bit different than we normally do. Normally, we ask for you to just go ahead and ask questions as we go, and we'll answer them as we go. But we have so much content to get through today. If you would, ask your questions as we go. As they come to your head, please go ahead and ask the questions in there. But we're going to wait till the very end until we come back to those questions, just so that we can get through the content. And keep in mind, when you guys do ask any questions, whether it's in the chat or the Q&A, it is completely anonymous. So those questions only come to Rachel and myself. Nobody else sees them. So that way, if you're one of these people that says, hey, I don't want to ask a stupid question in front of a bunch of people, you don't have to worry about it. It's just going to be us. So not everybody's going to see it. All right, perfect. It looks like everybody's hearing everything, seeing everything. We're good to go. All right. So when it comes to year-end tax planning or financial planning, there's typically kind of three different groups of people that I know that we look at. I know Rachel and I had this discussion that, there's kind of three groups of people that everybody fits into, and you might fit into more than one category. Those categories are going to be your employees, people that are still working, whether that's working for yourself or working for a company. There's going to be the actual business owners out there that run your own company. And then there's going to be the retirees. So the ones that haven't necessarily, they're not running a business, you're not working anymore, but you still have some year-end tax planning to do. And a lot of those categories, a lot of the subjects we're going to talk around retirees actually fit everybody. So let's get into the first set of people, which is our employees that are out there. Rachel, I know you and I, when we were talking about it, one of the things that I think both of us really like to see that employees have are those HSAs, those health savings accounts. So when it comes to that kind of investment, I guess you could call it, what do you typically get people to look at when it comes to their HSAs at the end of the year?
For the big part of it is the HSA even a good option for you? If you're one that has several health issues and you're incurring that out-of-pocket max is $7,000 or so a year per person, don't do the HSA plan. Switch your employee plan over to something that's going to make more sense for you, affordable. Keep in mind, HSAs, we have until basically April or filing of your return, that things like this, we have time to fund those, or if you over contribute or under contribute, you still have a little bit of a window into 25 to fix it for 24. Now, on the flip side, we're going to switch over to FSAs, which are slightly different than the HSAs. FSAs are a set amount that you kind of get based on your employer and how they set it up. Some employers have it to where those funds are completely depleted by the end of the year, or you have a little balance that rolls over, or they have even more so. But overall, most of those benefits do end at the end of the year. So I have to kind of laugh because my husband just messaged me yesterday saying that we had some left over. And so guess what my husband's doing in the next couple of weeks? So because we're going to use up that money. Yes. So that's free money that's on the table that you should use up. Plus get your health checked out, because otherwise if something pops up, that could ruin you financially as well. And then there's also dependent care benefits. So if your employer is generous enough to supply those, you do have to use those up by the end of the year. So most of them, you don't get more than $5,000 per dependent. So keep in mind that childcare, in order to get that dependent care not taxable, you have to have childcare expenses reflected onto your tax return. Okay. So you're paying grandma and granddad under the table, you're not going to be able to you're going to be taxed on that dependent care, because that dependent care expense isn't going to show up on your tax return. So just kind of keep in mind that those are set to expire December 31st. And so go ahead and use those up if you have any remaining.
For those that don't know, kind of rewind a little bit. You mentioned the FSA. What is an FSA?
That's a flexible spending account. It's a little bit more, more flexible than a health spending account. You can use it for over-the-counter medicines, which you can't use for an HSA. You can also use it for dental expenses, other medical expenses, things insurance maybe wouldn't cover. And so, yeah, it's a little bit more generalized for medical purpose compared to an HSA account. But it has, like I said, a set deadline that you have to use this money by.
Okay. And around this time, we also have, I know that we did our last webinar on Medicare enrollment, and that kind of started last month. But a lot of companies this time of year also have your health care enrollment through the company, correct?
Correct.
And so when you're looking at your HSA, your FSA, and then your health care options, I think what Rachel's kind of conveyed to everybody is basically take a look at what's going to best fit your needs at the end of the year, as far as what type of health plan to enroll in for next year. And if it's the high deductible plan, take a look at that HSA, see if your company offers the flex spending account. And if you need any help with any of that, get with somebody, whether it's, at your company or outside your company, get with somebody to help you figure out the right combination of plans that you're going to use there. Right. Kind of along the same lines, Rachel, at the end of the year, a lot of people are looking at their just overall benefits, their 401ks, their, the different types of plans that they have available for them, to try to make sure that they either get the max amount funded that they were trying to intend to, or, see where they're at on their limit. So what kind of recommendations do you have for people that are looking at their 401ks, their simple IRAs, their SEP IRAs, all that kind of stuff?
So the SEP IRAs and even your solo 401ks, those are, more your self-employed owners. And those you have more time. Those don't have to be done by December 31st. So we have a little bit more time. Unless you're deferring out of a wage. If you're deferring out of a wage, you have to have your deferment done by December 31st. So if you're looking to maximize that, you want to look at your most recent pay stub and see how much is left. It's $23,000 this year for those that are under 50. If you're over 50, it's $30,500 that you can contribute. So if you can max it out to, save on those taxes, that's great. Or you push it into a Roth option because of secure Act 2.0, there is a Roth option for every retirement plan out there. So that's something too that we want to take a look at, and maybe come 25, we switch out of a traditional 401k and go to a Roth 401k to cap on the after-tax savings that we'll have in those retirement years. But again, every person's a little different. Some people like to go ahead and save on those taxes now by doing the deferment out of the traditional 401k, which is funded with pre-tax dollars, meaning not taxed today, but taxed in retirement.
And that kind of brings up a question I get a lot now, especially with what just happened at the beginning of November, with the 2017 Tax Cut and Jobs Act is set to sunset in 2026. But now Donald Trump's got back in office. A lot of people think that he's going to extend the lower tax brackets. Have you had any recommendations or thoughts, or do you have any of your clients asking you about, do I put into a Roth now or 401k now, or do I do something like that later because tax brackets are going to continue to be lower? That whole conversation. What does that look like for you?
I have that conversation a lot. A lot of times it comes down to a lot of personal choices on that. But we're kind of finding things to the baby boomers because the whole IRAs and 401ks came out during the 1986 tax reform. So that was the big tax thing with all the retirement accounts. So everyone was thinking pre-tax, we'll save money on taxes now, we'll be in a low bracket in those retirement years. Now those baby boomers are now retiring and they're hitting the required minimum distribution age. All of a sudden that R&D is causing a very large jump in taxes. And so they're end up getting double taxation almost. And so there's two different things kind of going on there. And so there's years that we're like, okay, those years after retirement, before required minimum distribution, we switch over to maybe converting to the Roth, or we draw down higher on those accounts to lower your taxes in those required minimum distribution years. Plus, from an estate planning perspective, if your non-spouse beneficiary inherits a qualified retirement plan, so an IRA or a 401k, they're going to have to draw on those funds over a 10-year period, and that's going to be all taxable to them. So then they may be in a high tax bracket at that point. So then that money's getting taxed again at a higher rate. So we're finding Roth tends to be the better option, but I'm also finding that employers are not matching on the Roth, but they're matching on the traditional. And so we're trying to do this little bit of a split where we do part to the traditional, enough to get the matching, because that's free money on the table with an employer, and then do the remainder to the Roth to get that after tax savings. And then hopefully during those low retirement years before the required minimum distribution hits, we keep going in.
Okay, so the Roth versus traditional dance, if you will, has been interesting lately, and it's going to continue to be. I mean, with Trump getting back into office and him, there's a lot of things that he says that he wants to do from the tax perspective. How much of that do you see actually coming to fruition, and how's it going to affect people? Should they do anything different with their planning now as far as what they're putting in? Or is it kind of a wait and see type of thing?
It's a hard thing to say that. I wish if we had a crystal ball, Jaimin, you and I would be a lot richer. But it's a hard thing. It's a hard dance. Right now the Republicans have the trifecta, so they're going to be able to push through whatever they really want to. However, come the next election season, that could flip and things could get reversed and move back, and we could go back to what we were talking about during Obama's years of taxes, where the tax rates were astronomically high. That's always a good chance as well. So right now, short-term wise, yes, taxes are looking good, but there's always that caveat of that could switch real quickly. And, with our deficit, taxes probably do need to go up a little bit to incur that if we can't make it up within the economy itself.
Sure. And so from that kind of perspective, I think that kind of leads us into the next thing that you and I talked about as far as year-end planning, and that's kind of putting together your tax estimates. And then how do you plan for this? And how do you, estimate not only what are your income's going to be for this year, but then turning around and planning for next year. How's that look with you and what you're doing with your clients?
So we're doing that. We look at your kind of, where's their pay stub showing? If they're in a business, are their books up to date? Okay, where are their books showing? What kind of income that they're projecting? And see what we can start taking off the top. There's different depreciation avenues. There's a bunch of other different avenues when you're self-employed or own a business. When you're a wage holder and that's your main source of income, there's not a whole lot to do except maybe doing some more of the HSA contributions or the traditional 401ks or things like that. But overall, we want to just estimate out, hey, are we going to be owing a big chunk of money come April, or are we going to be getting some money back? Mm-hmm. And so we like to just kind of gauge it right now. That way, too, we can look at different deductions that are out there, look at different tax credits that might be available. And I'll go through all those as well. But that's the one thing is right now is the best time to kind of stop and look at where your picture is for the year. That way we have another month to make some adjustments or to, send off money or just go, okay, I'm going to have to write a check and just start making sure that we put money aside. That way we have money to pay that tax bill.
Because that's obviously a very important thing to do.
Yes, exactly.
And so when it comes to, you mentioned business owners and how they have a few more avenues as far as when it comes to tax planning and strategies that they can use. So for people that are retired, no longer working, they're drawing out of their IRAs or 401ks or whatever it is that they may have. One of the things that we see that kind of is beneficial to these types of people is if you have a hobby that you think, and I think you and I talked about this last time, mm-hmm. is that if you have a hobby that you can turn into a legitimate business, and it doesn't have to be a multi-million-dollar business. You could sell, blankets that you made on Etsy. And if you can turn that into a business, there's a lot of avenues that you can then use for tax strategies and planning. Because one of the things, Rachel, that you just kind of mentioned were those write-offs and depreciations. So when it comes to business owners, what are some of those write-offs and depreciations that they should be looking at here at year's end?
So, the biggest ones I always see are like, what are you already using at home that you're using for a business purpose? And a lot of people come up with, my printer, my internet, my cell phone, things like that, even like mileage. And I'm like, you should be keeping track of all that usage because it can be written off against the income. Now, if you're using as like a hobby and we turn it into a business, we don't want to get too excessive on those deductions. We don't want to get more than like a few $1,000 loss on that. But if it's a legitimate business and it's just starting up and things like that, it's pretty common for that business to be pretty in the red. But we look at, especially depreciation is a big one. So if you're going to buy like a new car and it's going to be a business asset, there's Section 179 for vehicles that are over 6,000 pounds. There's some caveats with it, things it has to be over 51% business use. But it's business use as of the date that you put it into service. So I've had some clients where we've been able to buy the vehicle December 30th. And it's 100% business use for that 2 days in December. And so that was it for the year. And it was 100%. So you're able to write off the car basically as that strategy. But if you sell the car before the useful life, which is 7 years, there's depreciation recapture where they kind of bring back the depreciation that you took in like kind of in excess, mm-hmm. As ordinary income. And so there is kind of that little trap. So don't just go buy a car every year because then you're just going to be paying it in taxes. It's not going to do you any good.
With that vehicle expense, the 179 that you mentioned, so it doesn't have to be 51% for business every year. It's just the years that you want to use it as the deduction, it has to be 51% or more in business. Is that right? Is that accurate?
No, so 179, it has to be at least 51%. And it's not at 51% business use, it's 100% deductible. it's if you buy $100,000 vehicle and you use it 51%, then 51,000 is up for a 179 deduction. 49,000 is considered personal use. So just kind of keep that in mind. So it has to be, it's pro rata based on your actual use, but to even get to that 179 basis, it has to be at least 51% business use.
Sure. See, and that's different than all those TikTok and YouTube videos tell us. So I'm glad you explained that. So one of the other things you mentioned was like bonus depreciation. As far as that's concerned, what does that look like for 2024 versus 2025? What kind of changes can people see on all of this?
So 2024 disappointed me a bit. There was the act that stalled out in Senate that was supposed to, increase child care credit, increase child tax credits, but it was also supposed to boost bonus depreciation back to 100% like it was in 2023. In 2022. So it was going retroactive for 23. For 24, that bonus depreciation is now at 60%. 25, it's 40%. Which means you get to take a 40% or 60% deduction up front. You don't get it's not the 100% that it was. Now that the election season is back over, I can see them kind of maybe retroactively doing it for 24. I would be really upset if they do it for 23 because that's going to be a lot of amending returns for me. But if it helps my clients, I'll do it. So
the necessary evils. Yes. What other types of business write-offs? I mean, we talked about the bonus depreciation and the 179s. What other write-offs should business owners be looking at this time of year?
I also look at paying kids. So if you're a sole owner, mom and pop place, and you have kids under 18, and you're structured as either a sole proprietorship, which goes straight onto a Schedule C on your 1040, or your partnership between mom and dad, you don't have to do payroll taxes on kids under 18. Your kids, not any kid, just your kid. Just to specify that one, no child slave shops, please. And so that one saves quite a bit of money too, because usually we'll pay the child up to the standard deduction. They don't receive anything. They receive the money, but they don't incur any income tax because the standard deduction wipes out their income. They have $0 taxable income, but you get the write-off of paying them the wage, and not the headache of doing it. Now you need to actually put the kids to work. So, find some things for them to do if that's the case. But that's a really good one. Another one is kind of maximizing out what's called your qualified business income deduction. And I'm going to preface this with folks that are into the arts, personal services. So the doctors, the lawyers, the accountants, the financial advisors. You guys, you can kind of skip this part because you're probably going to be phased out and then you don't receive anything. For the rest of you, if you're over the income limit, which is like $383,000 for a couple filing joint, you can almost knock off 20% of your business profit as tax-free. Once we get over that $383,000, we have to make sure that we have enough wages to kind of find a meaty spot to kind of make sure that we get this deduction as large as we can. So there's some playing around there, and that's a very technical area. So I would say you need to seek out an actual advisor for that one to help you calculate that, because there's so many pitfalls with trying to maximize it that people end up kind of messing it up by accident.
Sure. Okay. And then I know that obviously we've got our lovely different ways of accounting, accrual versus cash. I mean, how does that make, why we have to do things and make them more complicated? They're already complicated. I don't know.
I know. But that's a good one too.
For tax planning purposes or for end of year purposes?
For end of year purposes, so if you're on an accrual method, which basically means you're using accounts receivable and you're using accounts payable. So you send a bill out, you don't receive payment for 30 days or 60 days, however it works out. And same with accounts payable, you receive an invoice, but you don't pay it for another 30, 60 days or so. But as soon as it's entered into your system as a bill or as an invoice, it counts as either income or expense, whether or not the cash has actually gone out. However, for tax purposes, the default is cash basis, which is basically you're taxed on the income when it's received, and you receive the deduction when it's paid. Mm-hmm. So when we're switching over to things, we kind of want to speed up maybe our expenses for the year and hold off on sending out those invoices to kind of skirt it into for 2025. And that's a good way to lower our business income overall. Now, I'm going to say it just defers it. It's just kind of a kicking it down the can. So we're going to have that issue again in 25. But then again, we look at what we're looking at for 25. We kind of do this again, speed up and slow down, and we kick that can into 26. And there's years that maybe income starts winding down, things like that. And that's where it starts to kind of make more sense to do that, because then you're going to be in lower brackets as your business is winding down. And so that's when you kind of start recollecting that money.
All right. So we've gone fast. We've gone through a lot of business owner strategies and end of year thoughts, things that they need to think about. We've gone through some of the employees' stuff that they need to think about as well. And I think pretty much everything that you and I talked about kind of moving forward from here will address everybody. Everybody can look at this and see what types of opportunities are out there for planning purposes and for end of year, especially. But one of those, and one of the things that we see a lot of, are those charitable contributions, whether it's, just fundraising or for churches or for charities or whoever it is. There's a lot of that opportunity at the end of the year. So when you're looking at people that are genuinely charitable, what kind of advice do you give them when it comes to end of year, as far as what are their timelines? What do they need to be looking at for those end of year contributions?
So keep in mind that contributions to be tax deductible need to go to a 501c3 that's in good standing. Keep that in mind, because there's a lot of 501c3s that are not in good standing. You can go onto an IRS website and go to, there's a section for charities, and you can look up charities, and if you can't find it, don't give them money unless you just want to out of your goodness or heart, but you're not going to get the tax write-off. So just kind of keep that in mind. Secondly, we look at different avenues of how to donate. I mean, we can do the traditional way of doing money, check or cash. As long as that check is written by December 31st, it's good for 2024. Whether or not, the church cashes it into 25, that's fine. It's just, you have to write it by that time. But we can look at non-cash items. So if you're cleaning out a house or something like that, furniture, things like that, you just need to make sure you document what you gave away, because the IRS will ask for it. They'll want pictures, how you ascertain that value. I'm going to have to say TurboTax actually does a good job of going through and doing a good kind of donation value on items like that. You'll kind of put in what it was, as much info as you can, and it'll spit out different values for you. There's also giving away highly appreciated stock. That's a good one too, to kind of mitigate your capital gains. So there's different avenues there. If you're into your required or minimum distributions, we can look at doing qualified charitable distributions, which means you're fulfilling your required or minimum distribution by that money going to a charity. Not all of it, just some of it. But it also takes it out of your taxable income. It takes it out of your adjusted gross income. So for those that are dealing with IRMA thresholds, that's a good way to kind of knock your IRMA threshold down a little bit, instead of going from your IRA to your checking account to the church. And keep in mind too, charity really only benefits you tax-wise if you can itemize. If you cannot itemize, you're just doing it out of your goodness of your heart.
But even if you don't, and you give to the charity, let's say your RMD, you give to your RMD to the charity, it still does not count as taxable income for you, or does it?
It does not, yeah. So if you go straight from the IRA to the charity, it is not taxable income. And keep in mind that you can only do a QCD once you hit 70 and a half. You can't do it younger, you can do it older, but at 70 and a half is when you can start doing that.
Gotcha. Okay. And then, a big one for Texas, since we don't have our state income tax, is our property taxes, and those are always a fun topic in Texas. But I'm sure other states deal with the same thing. But when it comes to property taxes, what does everybody need to look at the end of the year?
For a good one, fight them every year because, they're kind of ridiculous at this point. And it would help everybody if we could get our values down a little bit. But other than that, property taxes are capped at a combination of property taxes, sales tax, if you file, out of state income taxes at $10,000 on your itemized deduction. So if your taxes are already at $12,000, go ahead and pay it. Don't do the double up method because you basically lost out on 1 year of being able to itemize if you're going that route. Prior to tax reform, it was a common method to double up every other year to kind of get or skirt around the AMT tax, but we didn't have this issue of the cap at $10,000. Sure. So it is good to go ahead and pay them by the end of the year if we're able to itemize and kind of skip the doubling up at this point because it's not helping anybody. But
that could be something to use in the future. I mean, depending on obviously what happens with the tax laws and all that kind of fun stuff that change every 4 years. So
yes. I mean, I don't see that one changing. I see, with everything Trump's talking about, I still see our itemized deductions staying the way that they are. Because it did lower the audit rate, which Schedule A's were like the number one audit out there. And so this did cut that out quite a bit by raising the standard deduction and doing all this capping. But yeah, for us folks in the high property tax value, it hurts to lose a deduction.
Yeah, just something you got to deal with, I guess. But, again, talking about IRAs with the RMDs and, you can do it as a charitable deduction. But what if you don't? I mean, what is it that we're looking at with IRAs at the end of the year? And the big one that I know that comes up with a lot of our clients is the conversion strategy and moving IRAs to Roths. But when it comes to those two different types of investment vehicles, what is it that we need to be looking at towards the end of the year for tax purposes?
So when we're looking at the Roth conversions, we're looking at, okay, how much can we offset over to the Roth? Without incurring too much tax, because usually we don't want to go over a 24% bracket because then we start to lose out certain credits and certain thresholds and things like that. Plus, it jumps from 24% to 32%. There's not a nice, happy little middle there. And so we look at that. But then furthermore, we look at our IRMA thresholds because no one likes paying really high Medicare premiums, and Medicare premiums are a 2-year look back. And so when we're converting, we're kind of trying to stay around and we're looking at our clients. Okay, if we do this much, we're going to be into the second tier of IRMA payments. Are you comfortable making those payments come in 2 years later? Sure. But because we can offset more into your Roth is that way. So we have to look at the opportunity cost there of switching over to the Roth, but increasing IRMA payments, or leaving it in the traditional IRA and keeping our IRMA payments maybe lower, keeping our taxes a little lower. There's a bunch of different comfort levels there that go to an individual that we just kind of try to walk everybody through. Here are your options. Here are the consequences of each of those options. What would you like to do? And it's still an estimate, so don't ever hold us to it because at the end of the day, this is based on information that we have. Some people sometimes get surprises of, I forgot that I cashed in some CDs, and all of a sudden they had $40,000 extra in interest income. So now we're over. So all that hard work was for nothing. So some of that happens as well. So it is just kind of a guessing game a little bit, with an educated guessing game, but also a comfort level for each client.
Yeah, and I know that, when it comes to our side of things, the financial planning side of things, and we're going through Roth conversions at the end of the year, Rachel, you and I had this conversation yesterday about there's 1,000 softwares out there that try to calculate this stuff for you. There's free softwares, there's tax softwares, there's financial planning softwares, and they all give you different answers as far as what the best strategy is. And the problem with all of them, to be honest, is that you can't predict the future. So we don't know what the tax codes are going to be more than a couple years out. So we can only use like you said, the information that we have available to us at the time to say, look, the way things are now, here's your best strategy for Roth conversions. Or, paying more now, paying less later, paying less now, paying more later at different rates, whatever it may be. That's all stuff that needs to be calculated, but you can only use the information that you've currently got. But I think one of the things that Rachel and I both kind of agree on when it comes to Roth conversions is if somebody's in that 10 or 12% bracket as far as income, you might as well fill up the 12% bracket and try not to take that extra 10% jump into the 22. If you're already in the 22 or 24, a lot of times you may as well fill up the 24% bracket, without taking that next big jump to 32. And so those are kind of your main guidelines, if you will, of fill up your 12, fill up your 24, and see what the taxes look like for you. But then turn around and possibly say, okay, I want to fill up the 24, but here's what's going to happen with IRMA if I do that. So you've kind of got to take both considerations in, not just your brackets, but also the thresholds for IRMA, and sitting down and figuring out, or getting with somebody that does this every day and have them calculate out for you, here's all the different brackets, here's all the different amounts we can do a Roth conversion on, and then here's your consequences of each one of those. Then it's a discussion to say, hey, what are we comfortable with? What do we think is going to happen down the road? And making an educated guess based off of all the information. So Roth conversions are a fun one. I definitely recommend
they are
getting with somebody and figuring out what works for you and your income level and what your goals are for that money.
And it's fun. It's fun to kind of project out to just what taking out of your traditional, 401k, like, you take $40,000 out, how taking out that growth on the $40,000 helps kind of stagnate the growth as well that was going on in there. That way it makes your RMDs lower. And so it's kind of fun to kind of show the different angles of these Roth conversions, because there's so much to go over. And like I said, it comes down to a lot of just personal comforts of what they want to do with their money and how they see their money working for themselves. So yeah.
Well, one of the things that I've run into, and correct me if I'm wrong here, Rachel, but I think we had a little short conversation about this, is it also has a lot to do with your risk tolerance. So if somebody is more aggressive in nature in their investments, it may make more sense for them to do a Roth conversion, because now they've got a more aggressive approach in a tax-free growth account versus somebody that's more conservative, that may not get a whole lot of growth in that tax-free account because they're being so conservative. They may have been better off just leaving it in the IRA and letting it continue to grow tax deferred there, and maybe possibly paying a little bit more in the future in taxes, because that opportunity loss of the aggressive growth in a tax-free account just isn't there for a more conservative investor. So,
right.
it's another angle to look at this from.
I know, yeah.
Fun. But, as far as the IRA, if you're not doing Roth conversions, we talked about RMDs a little and how you can distribute those to a charity. But if you don't, the importance of taking your RMDs, a lot of people don't realize the importance behind taking an RMD and what penalties that they can receive if they don't. So currently, What do those penalties look like for people?
It's 50% of your shortfall of your RMD. So if your RMD was $10,000 and you took out $2,000, there's a $4,000 penalty on that $8,000 shortfall. That was a lot of numbers in a short period of time. But it's a pretty hefty penalty. And I know with my own clients, with clients that we know that are in RMD age, we are looking for those RMDs. And we ask for the forms that they're generated each year to calculate out what it should be. That way we can double check, hey, did you take enough? That way too, if they didn't, we can let them know. They can correct the situation. They take it out immediately. We can fill in the waiver form with the tax return saying, hey, they forgot to do it. Please forgive it. So if you do forget it, it does happen pretty often, especially, you get someone in their 90s and the mind starts to go. Things do happen. The IRS does typically do forgive it as long as you're catching it and correcting the situation and doing it by their book. Yeah.
Just get it done in a reasonable amount of time as soon as you figure out that you didn't do it.
Just get it done if you can.
One of the tax questions I get a lot when it comes to RMDs is the example. We'll go with the example that you gave. If somebody has a $10,000 RMD and they take their full RMD like you're supposed to, that $10,000 is now taxable. It's at whatever your income bracket's at. But if you don't take it, let's say you don't take any of the 10,000, then you not only have to take the 10,000 and that all becomes taxable as it would have, but you also have a $5,000 penalty, and that $5,000 goes straight to the IRS. The question I get is that $5,000 also added to your taxable income for the year?
It's not. It's added onto your taxes, unless you're taking out the $5,000 penalty from your IRA account. But if it's written from a checkbook, it's not going to be added as income.
So if anybody does incur one of those penalties and doesn't get forgiven, the strategy will usually be to write that out of your checking account. Don't take that out of your IRA to pay off, because then you're paying more taxable income.
Right. Unless you want to use that $5,000 as to satisfy your RMD for the following year.
Yeah. There you go. Okay.
It's like that snake that's always eating its tail, never ending.
Yeah. That's the IRS, the snake, right? No, I'm just kidding.
Exactly.
IRS is listening. Just kidding. Okay, cool. So we got a lot on the IRAs there and Roth conversions and what we do there. We've got a few minutes left until we need to get to the Q&A portion. So the last thing I kind of wanted to touch on with you is what Don, the estate planning attorney that we had on this webinar, would love to hear, is the estate planning side of things at the end of the year from a tax planning perspective. So if you're looking at gift giving or any of that kind of stuff, what are you looking at if you're doing estate planning as well as tax planning at the end of the year? What is it that you recommend that people do kind of in that area?
So one, if you've been working on doing estate documents and you have some last minute items that you need to do, get that done, because that could end up biting you in the butt the following year as a gift issue. Currently, this year for 2024, each person can gift $18,000 to another person. So mom to a child and then dad to a child. So a married filing couple, $36,000. Mm-hmm. They can do that without reporting a gift tax return. No one incurs any tax or anything like that. Now, to jump to a larger scale, each person has right now $13.6 million that they can either die with or give away. That's over the annual threshold, so over that $18,000, without incurring what's called the estate tax, or what everyone calls the death tax. And so that right now is really high. So not as many people are finding themselves in the boat of being subject to it. But if we're looking to go ahead and start gifting and lowering our estate, because, I know Jaimin's talked about a book called Die with Zero, but it's like, might as well enjoy the money, let your kids enjoy the money now, because once you die, it's not yours anymore. So it doesn't really matter. So while you have that control and you're interested in doing this, gifting's a big one. Now, Jaimin, last session, you stumped me on a question, so I'm going to ask you one.
Oh, here we go. Okay.
Yes. If you write a check for $18,000 to, say, your daughter, but she doesn't cash it until 2025, is it a gift in 24 or is it a gift in 25?
Well, I'd assume it's just like all the rest of the deductions that you can do, that if you write it and it comes out of your possession in 24, then it'd be for 24.
So that is the trick question. The IRS has taken the stance that if you cashed a check in 25, it's a 25 gift, even if it was written in 24. So if you do this and you're looking, so if you're looking to do this, make sure that they go and deposit that check before the end of the year. That way it doesn't mess up your gifting for 2025. Again, if you do go over the gifting limit for next year, no big deal. You have to file the gift tax report. There's no tax due still because we're not in that 13.6 million window yet. But when you die, those gifts over the amount come back into play. And so that's where this kind of comes into. And so we look at gifting. We look at trying to get things out of the estate if we can, especially since the value is still so high. There's a portability that so far they're saying that if we do gifting now when the exemption is so high, they'll honor it if we bring the exemption back down in 2026, because even though Trump's back in office, tax reform is still set to expire January 1st, 26. So that 13.6 comes back down to about 6 million. And that's not hard to hit once you die. If you think about a couple that has a house, some retirement accounts or things like that, I mean, unfortunately, it's not hard to get up to 6 million in fair market value at date of death anymore. So kind of keep that in mind.
That brings up a good point, is Trump's first 100 days could be very important for tax planning and estate planning purposes to see what he does. And I'm glad you're bringing up the kind of grandfathering in the gifting that you do now, because if you think about it, a lot of couples, in their 60s and their 70s, they say, "Oh, I've got 13.6 million, that's available. I don't have that much money. I'm not going to hit that much money." But the problem really becomes is, you have 13.6 million if you die right now, but you're not going to. I mean, you're probably going to live a little bit longer. And so the idea is, why not gift some of that now while the exemptions are really high? Because let's say 10 years from now, heaven forbid, they bring the estate tax all the way back down to $1 million, which it used to be. And now you didn't do any planning for that. And you've got all this money that you've built up over the last 10 years in addition, all the growth and everything like that in your accounts. And now you're way over. So it's better to start the planning now while we've got these higher limits than to just wait until, you're 86 years old and then have $1 million estate tax. And then now you're really in trouble. Right.
And sometimes some of the estate planning too does behoove you what to do when you're younger. There's different avenues there. I think of charitable remainder trust or self-canceling installment notes, some real technical things. But when you do them when you're younger, you actually have they're kind of based on your life expectancy. Mm-hmm. So it ends up being a better benefit when you set this stuff up younger when you can. And so go ahead and get those estate documents in order. Just review them. You can talk to an attorney. Jaimin, I know a great one. Hi, Don, you're on here. And two, with the estate planning process, I mean, you're going to work with the financial advisor. You're going to work with the accountant. There's going to be kind of a tripod of advisors that are going on with that, because there's so many different avenues that it's going to take. And we just want to make sure that every method is met, and that everything's done to make sure you're getting the money the way that you want it to go to. So
yeah, and as she mentioned, the kind of the trio of people that advisors that you'll need or should get help from when it comes to the estate planning side of things is, you want to make sure it's done legally and that it fits all the legal requirements. So there's where your attorney fits in. You want to make sure B, the whole purpose of this is that it is going to save you as much in taxes as possible. And as much of that, your assets go to your family members or beneficiaries, whoever they may be, not to the IRS. Well, there's your accountant comes in. And then C, you want to make sure it's not screwing up your current retirement or financial plan and not leaving you high and dry, so to speak, when you got taxes paid down to a minimum. So that's where the financial advisor comes in. And so getting all help from all three on an estate plan is definitely going to be more beneficial to you than just going to one and just getting the legal aspect, or going to one and getting just the tax, or going to one and just getting the growth of your assets. They're all very important.
Right. And I will kind of stress too, of the estate tax, it usually doesn't hit until it's the second spouse to die, because gifts or transfers to the spouse are not going to be considered a taxable event. So it's usually we find out it's the second to die, which is usually the wife, because, the man sometimes chooses to, because we nag him to death is how the joke goes. But at other times it is the guy, and then they're just going to blow through the money anyways. So.
All right. Well, I think we've covered a lot of information, and we've got quite a handful of questions here that we will try to run through. I know that the scheduled webinar was intended to end in 7 minutes. I think, Rachel, as long as you've got time, we're going to go through all of the questions that we've got in here. So people, feel free to stay around and listen to the questions and answers that we've got for them. If you do need to jump off, no problem. if you have any more questions that you would like to ask one of us, again, I'm going to ask you to just reach out to us. We're more than willing to help, whether you're a client of ours or not. We're willing to help you and see what we can do. But let's start going through these. And I'm actually going to go through kind of in reverse order of when they came in, because that's the most recent topic that we've talked about. And then we'll go backwards. Let's see here. I got one from Lawrence that says, what role does life insurance play in mitigating income and estate taxes for high net worth individuals, especially in the context of tax legislation? So I say this is one of those that kind of comes from a couple of different avenues. I'll let you go first.
Yeah, I can just see Dawn sitting back going, what is she going to say here? So the biggest one with life insurance is for estate planning. A lot of it is final death expenses. So I call it the get rid of you policy. So usually you want a policy that's going to handle your funeral, handle your administrative costs, with the legal proceedings, things like that. Any medical expenses, things like so those are that's kind of the small policy. If you're subject to the estate tax, then we kind of look at doing a life insurance trust for you, to where we take out a life insurance policy that's held within a trust. And the purpose of that policy is to pay the estate tax. That way your assets aren't being depleted to your beneficiaries. The policy pays the tax. Your assets go to the beneficiaries. So those are just a couple of quick little policies there. I'm sure.
No, you covered exactly what I was going to mention, which is that the whole point of the insurance policy to pay your taxes is one it's a widely known strategy that a lot of people use, and it's essentially you are giving more money. It's a way of you protecting the money that you're giving to your beneficiaries, whoever it may be, churches, charities, kids, grandkids, whoever. It doesn't really matter, but it's a way of them getting as much as possible without the IRS taking 40% or whatever it may be, and then your beneficiaries are left with less. You'd rather leverage the money you have now in a life insurance policy and let the life insurance company pay the IRS their portion. Can rolling over funds from a traditional IRA to a Roth IRA, the Roth conversions we were talking about, do those count as RMDs?
No. Once you become RMD age, you can no longer do a Roth conversion.
What about the healthcare cost that is currently at 8.5% of gross? Converting to Roth effectively costs 20.5%. Do you still do it, or do you wait until Medicare is available?
So let me see if I can follow this one. So you're talking about the 8.5% AGI threshold, is what I'm assuming here. So if this 8.5% AGI one that we're talking about, this is to get out of early withdrawal penalty for the threshold there. If your medical expenses are over the 8.5% of your AGI, you can take money out of a retirement account without penalty if you're under 50, the 59.5 mark. Now, transferring it over to the Roth, the healthcare, it's not the same thing that's going on there. There's two different issues going on there. So you can pay medical expenses from your IRAs without penalty if they're over that 8.5%. Does that make sense? Is that answer?
Yeah, I hope that makes sense for you, if that's what the answer you're looking for. If not, you go ahead and type something else in there to kind of clarify, and we'll try to see what we can do to help you there. Linda, I have to jump. Really enjoyed listening. Also glad, this is one of your clients. Also glad you do my taxes. Okay. Cindy, on depreciation of a rental property. She said, we depreciate every year. We've owned it for 21 years. When we sell, do we reclaim the depreciation for tax purposes? Say we bought the house for $200,000, we sell it for $400,000. Do we pay tax on the full $400 or the $200 profit?
So this is a good question. So rental properties, for the most part, they're not subject to bonus depreciation. They have to be done by straight line depreciation, especially like the home itself. So when you're depreciating an asset on straight line, you're not doing any kind of accelerated method. So there is no depreciation recapture. Your capital gain, though, is going to be your sales price less your original cost basis, plus the depreciation that you've taken so far on the property, and then take out any of the selling expenses. And that's going to be your capital gain. Now, I will say a fun little strategy that I do for some retirees that do have a rental property. If you're up for it, go live in that rental house for a couple of years and sell your primary home if that's the way you want to do it, or rent out your primary home and go live there. And after 2 years, if you meet the ownership of 2 out of 5 years, you can claim primary home sale exclusion on a rental on a house that was previously rented. So you can get up to $500,000 of capital gain excluded because you sold your primary home. And then you can move back into your old house and stay there for another, as long as you meet the 2 out of the most recent 5-year period for your ownership test. So kind of throw that out there that you can kind of get out of the capital gain by doing this. It's a lot of extra steps and could be long-term, but if you're ready to get rid of it, your capital gain is not going to be subject to depreciation recapture in this instance.
So here's a question. Does it have to be 2 consecutive years of the 2 out of 5? So for example, now I'm kind of getting off topic here, talking about a specific client that I was thinking of who's got multiple rental properties. If he were to, say, figure out a way that he can live in each one of them a few months out of the year, every year for the next 5 years, and it totals 2 years over the next 5 years, could that work for that same strategy?
Technically, it could. It's going to be a hard one to justify, though, because if how do you claim primary residence for just a few months out of every couple of years? So that one's a little bit of too much of a gray area in my. So yeah.
Okay. Fair enough.
Okay. Looks like Todd came back with. Okay, he's talking about the healthcare.gov. Okay. So in this instant, this is one that's going to be good for a tax estimation. This isn't going to, you may be still eligible for a Roth conversion, and it still may work for you for this way. We just need to look at what we're talking about, the opportunity cost. That marketplace insurance, it can be brutal if we go over those certain income thresholds. But again, it depends on what your filing status is, what your other income is. There's a bunch of other different things that are going on for me to be able to answer this question. So this is a good one for you to kind of do an estimation of what your income is prior to converting, seeing where the income thresholds are, and seeing if there's any wiggle room to add on to that for a Roth conversion.
Todd, I hope that answers that question for you. And if you want to get that tax estimate that she was talking about earlier in the webinar done for you, I'm sure that you could reach out and she'd be happy to help with that as well. Keep in mind, people, and this is a conversation that I had with her actually yesterday, which was, if you need help with your taxes, if you think there's more that you can do with your taxes than what you're currently doing, say on TurboTax or whatever, and you want to go find a CPA that's going to help you for 2024 and forward, go now. Go now, because most CPAs will not take new clients come January. They are too busy with their current clients and filings and everything that are due in April. So it is very tough to get in and get help from a CPA come January through April. So either do it now or wait till May. But so anybody that needs help, go try to get your help right now.
Yes. There's on top of that, I mean, just the field being so busy, and the reason why is there's just a huge overall CPA shortage in the state, but there's an even bigger tax CPA shortage going on. And quite honestly, it's because so many die at tax filing time because of stress and bad diet. And so the younger folks are kind of scared to get into the field.
Makes sense. So when we've got, CPAs like yourself doing 1,200 tax returns or whatever it is that you're doing, I could see how that could get a little stressful.
A little bit, yeah.
Let's see here. What tax policy changes might we expect under the new administration, and how should I prepare for them? I think we talked about that a little bit. Lawrence, in my opinion, this is a personal opinion, the first 100 days is going to tell us a lot. And I don't know what we're going to be able to do necessarily this year other than plan for what we already currently know, which is that sunset in 2026. I mean, we can't plan for something we don't know yet. So I think a lot of those questions are going to get answered by the end of March. I would hope.
Right. I know most advisors in my field, we were watching for the election to see what happened, to see if we wanted to kind of front load different strategies now to kind of actually pay in more taxes now in 25. Given that now it's Republicans, now it's like, okay, maybe we don't want to do that. Let's just keep going with the way we're doing, because most likely things will remain semi-same for 2026 and going forward. Like I said, I think it will be next election and next three-ring circus that we will have to figure out what's going there. It's always the Internal Revenue Code is always a chess game, and it's always changing. And there's always, even with laws that have been in existence for years, the IRS will suddenly flip on their previous guidance, and it'll be challenged in tax courts. It gets dragged through the mud, and all of a sudden, a strategy that everyone was doing is no longer a plausible strategy. And so there are things like that we just always have to be on the lookout for. As of right now, nothing has changed into 2025. And like Jaimin's saying, 2026 is the year to be watching.
Holly asked, is that $30,500 total include my contributions and employee contributions? I'm assuming that's the 401k contribution.
Right. It's just the employee deferral. So not the amount that your employer matches.
Gotcha. We've got a couple new ones coming in here. Cindy, who asked about the rental properties, says she's still confused. Do we pay tax on the $200,000 gain, or how much of the depreciation do we have to recapture and pay tax on? So is it straight line depreciation?
It is going to be straight line depreciation. Your gain is still going to be, it's not going to be the 200,000. It's probably going to be more, because your original purchase price, so if you bought the house for $200,000 and you took $50,000 of depreciation over the years, now your new purchase price is basically $150,000. So now 400 minus 100, 400 minus 150 instead of 400 minus 200. So your capital gain will go up because of depreciation, but keep in mind that depreciation lowered your ordinary income, which is a higher rate compared to capital gains. So just kind of keep that in mind, that you're still better off taking the depreciation.
Assuming that capital gains are staying where they're at.
Right. So if you're doing it in 24, you're fine, even in 25.
Lawrence had another question of, how do you approach tax planning for individuals with multiple income streams, such as business ownership, investments, passive income, etc., to ensure compliance while optimizing the tax efficiency?
Oh, fun. So we look at everything. Yeah. So we look at everything holistically from kind of a get-go, kind of like, okay, where's the big picture? And I like to always talk to people, what is your overall big picture? What are you planning for retirement? What do you plan on drawing on first? And this is where things we start to, Jaimin and I talk about mutual clients about these type of things too, because his investment and retirement strategy may be different than what I'm thinking from a tax planning strategy. And so it's a kind of a conversation to, okay, here are your different avenues that you have. What would you like to do? And different consequences, the different actions. When it comes down to like your investment strategies and things like that, I hope Jaimin's making you a ton of money. That's fantastic, because then that means you're going to be paying more tax, but at least then we can kind of estimate out what it is based on your capital gains and things like that. Your business income, we might be able to look at, okay, what are some deductions that we're missing that we can start taking? How do we maximize that qualified business? Maybe we add in another retirement plan as a tax savings vehicle. And then with private investments, we can get into very specific things called grouping elections, where you can basically classify some of your investments as one and be able to take it as non-passive versus passive. So that's a fun technical loophole that I like to go down. But I won't get into that one too much. But overall, it's holistic, and then it gets into the nitty gritty, depending on what everything you have going on. And again, for me, I like to get involved with their other advisors, That way, no one's stepping on anyone's toes. You stay informed about all these different strategies that are going on. And that's the tax planning I like to do.
Sure. And I mean, a lot of the financial planning has tax implications. So when you're looking at putting together a financial plan to grow as much money as possible, that's always, the ideal. But it needs to be net of taxes. So if there's a strategy that might, on a percentage basis, grow a little bit less, but it saves you a ton in taxes, and so your net overall, you have more money, that's the most important thing. It's your net of tax money that's the important, because that's what you get to spend. And then we've got Jonathan, who said any money they spent to improve the rental gets added to the cost basis.
That's true as well. But we were just taking it from a very simplistic point of view of just the home. There's a million other things that can kind of factor into your capital gain. But from a very simplistic point of view, it's just if the depreciation lowers your cost basis in the home. But if you add improvements, that adds your cost basis. Like I said, there's things that go on. But from a simplistic point of view, that was what I was trying to drive home.
Perfect. It looks like we've answered all of the questions that we've got so far. Again, if you guys need help with any of this, please reach out. Either Rachel or myself would be more than happy to help you with any of this and get you any of the questions answered that we can. But it looks like if that's it, then we'll go ahead and wrap up for the day. For those of you that watch these on a monthly basis, next month, just so you know, is a little up in the air right now with Christmas and everybody going on vacations and all that kind of stuff. We're unsure on the date that we're going to do it. So we will shoot out emails to anybody who attended today, as well as anybody who's attended in the past, and get you that notification when we have time. Rachel, again, thank you. As always, fun to have you on here and dive into the tax world, the complicated
Oh,
tax
yes.
world.
We could spend days on here,
tax code up to now?
Your head would be spinning.
I'll say, do you know how many pages the tax code's up to now?
Oh gosh, it's ridiculous. No.
Yeah.
I mean, there are sections of the tax code that are in a dark corner that I have never even seen. But a lot of them come down to like foreign assets and corporations and things like that. That I don't have to get into because I don't have any large foreign corporate assets. So
yeah, perfect. Well, thank you everybody who attended and who came today. I hope we got a lot of questions answered for you. I hope we also kind of ignited a lot of questions in your mind about what you should be looking at doing here at the year end. And I can't emphasize enough, get some help if you need it. If you have questions, you don't have answers, don't Google it, please. We talk about this all the time as your TikTok and your YouTube gurus and all that. Please, ask a professional that does this on a daily basis, whether it's us or somebody else. Please get some help from somebody that knows what they're doing. But thank you again for coming on. Rachel, thank you. And
of course, thank you for having me.
Of course. And I think that's it for today. And we will have Rachel on probably a few times next year because I think everybody enjoys these. So we will talk to you guys later. And thank you again for coming.